Hey everyone, and welcome. We're diving straight into a full-throttle revision of Chapter 1, Nature, Objective, and Scope of an Audit. My only goal here is to make sure we cover every single concept, every little detail, to get you 100% ready for your exams. So let's get right into it. All right, first things first, let's blow up a huge myth right from the start. Answer this question in your head honestly. If a company gets a clean audit report, a thumbs up from the auditor, does that mean it's totally 100% free from any and all fraud? If you said yes, or even if you just hesitated for a second, you need to stick with me. This is seriously one of the biggest traps students fall into, and by the end of this, we're going to clear it up for good.
Okay, now let's get practical. Imagine this scenario. It's straight out of an exam paper. A company releases its audited results on a Friday. Everything looks good. But come Monday morning, the stock market opens, and boom, the share price completely collapses. How is that even possible? Well, it happens because what an audit report actually is and what people think it is are two very different things. This exact gap between perception and reality is a favorite area for ICAI to test you on.
So to really understand what's going on, we have to start with the fundamentals. What is an audit really? We're going to break down the official definition word by word. And trust me, in your ICAI exams, every single one of those words can mean the difference between getting marks and losing them.
So here it is, the official definition from the ICAI. Now I know it looks like a long formal sentence, but it is absolutely packed with crucial keywords. So let's not just read it, let's deconstruct it, piece by piece.
Let's start with independent examination. This is the absolute core, the bedrock of our profession. It means the auditor has to be completely unbiased, no influence from the company whatsoever. Next, it's an examination of financial information, the balance sheet, the P&L account, the cash flow statement. Then there's the phrase of any entity. This is key. It doesn't matter if it's a massive public company, a partnership firm, an LLP, or even a nonprofit. Audits can apply to all of them. And finally, the most important part, and this is where marks are often lost, so listen up. The whole purpose is to express an opinion. An audit report is not a guarantee. It is not a certificate that everything is 100% perfect. It is a professional opinion based on the auditor's work. You have to nail that point.
Okay, so we know an audit is an examination. But what's the auditor's playing field? What are they supposed to look at? And what are the boundaries? That brings us to a really important concept, the scope of an audit. If you don't understand the scope, you can't understand the auditor's responsibilities.
So, what determines an audit scope? It's basically built on three pillars. First, you have the terms of the engagement. That's the agreement, the contract, between the auditor and the client. Second, there are the requirements of relevant legislation. Think of things like the Companies Act 2013. And third, and this is super important, the pronouncements of the ICAI. This means the standards on auditing, what we call the SAs, are mandatory. They aren't optional guidelines, they are rules you have to follow.
Now check out this classic exam-style situation. The client comes to the auditor and says, hey, our cash sales are a bit of a mess. Controls are weak, so maybe just don't check those vouchers. What should the auditor do? This is a classic example of how ICAI twists this concept. The answer is simple and non-negotiable. Management cannot restrict the scope of an audit. If they try to put limitations on your work, you can't just say okay. You have to address it in your audit report, which could mean giving a qualified opinion or even a disclaimer of opinion.
This leads us right into another critical distinction, audit versus investigation. They are not the same thing. An audit's purpose is to form an opinion on whether the financial statements show a true and fair view. It's a general examination. An investigation, on the other hand, is like a targeted mission. It has a specific purpose, like finding a suspected fraud or figuring out a business's valuation. An audit is not an official investigation designed to unearth every single wrongdoing. It's a very common point of confusion.
So, what does an auditor actually do day to day? Well, here's a quick rundown of the key things they cover. They examine the company's accounting system and its internal controls. They check the math, the arithmetical accuracy of the books. Super important, they verify that transactions are real, that they actually happened and are valid. They confirm that assets and liabilities on the balance sheet actually exist and are valued correctly. They make sure all the legal requirements are met. And all of this work, this entire process, culminates in that one final report on the true and fair view.
All right, so now we know what an audit is and what it covers. But the next logical question is, why? Why even bother with an audit? What's the real point? Let's talk about the practical value,
the different types, and the huge benefits of having an audit done.
Broadly speaking, you can split audits into two main categories. First, you have audits that are required by law. For entities like companies under the Companies Act or banks and insurance companies, it's not a choice, it's mandatory. Then you have voluntary audits. This is where, say, a proprietorship or a partnership firm decides to get an audit done on their own, not because the law forces them, but because they see the value in it.
And what are those benefits? Well, there are a ton. An audit safeguards the financial interests of everyone involved, the owners, investors, even the lenders. It also acts as a powerful moral check on employees, making them less likely to commit fraud. And on a practical level, it helps with things like settling disputes or insurance claims, makes tax calculations easier, and, a big one, makes it way easier to get a loan from a bank. Basically, audited financial statements have a level of credibility that unaudited ones just don't.
Let's get really specific now. What is the ultimate goal? The ICAI has laid this out very clearly in one of the most important standards of all, SA 200, Overall Objectives of the Independent Auditor. You absolutely need to know this one.
According to SA 200, the auditor has two core objectives. The first is to obtain reasonable assurance. And I want you to focus on that word reasonable, not absolute. So many marks are lost right here. An audit provides a high level of assurance, but it's not a 100% guarantee. The second objective flows from the first, to express an opinion and issue a report based on the audit findings. Reasonable assurance leads to an opinion.
Okay, so if the goal is only reasonable assurance, not absolute, that naturally implies that there must be some limitations, right? Exactly. And that brings us to what is, without a doubt, one of the most frequently tested topics in this entire chapter, the inherent limitations of an audit. This is a big one. So let's circle back to that big, tricky question from the beginning. Why do we still hear about massive, multi-crore frauds happening in companies that are audited every single year? The answer lies right here, in understanding these inherent limitations that make it impossible for an audit to ever be a foolproof guarantee.
All right, you're going to want to write this down because this is a certified exam favorite. First limitation, the nature of financial reporting. Financial statements aren't just hard numbers. They involve management judgments and estimates, like provisions for bad debts. These are subjective. Second, the nature of audit procedures. Auditors use sampling. We don't check 100% of transactions. It's just not practical. Plus, even if we did, clever collusion among employees can hide fraud from even the best auditor. Third is a practical reality, timeliness and cost. An audit has to be completed in a reasonable time and at a reasonable cost. Checking every single thing would be impossible. And finally, an audit is backward-looking. It cannot predict future events. An auditor's report doesn't guarantee the company will be profitable next year.
Now, to navigate all these complex issues, the judgments, the procedures, the limitations, an auditor can't just know about auditing. This brings us to our last topic for this chapter, how auditing is connected to so many other fields of knowledge. A truly effective auditor has to be a well-rounded professional.
You see, auditing doesn't exist in a vacuum. Of course, accounting is its foundation. You can't be an auditor without being an expert in accounting. But you also need to know law to understand regulations like the Companies Act or tax laws. You need economics to understand the business environment your client operates in. You even need behavioral science to deal with people and understand their biases. And obviously, statistics and math are crucial for sampling, and financial management is key for analyzing ratios and capital structure. It's all connected.
Okay, let's put you right in the exam hall for a second. Imagine you see this question. Your client comes to you, they want an assurance report. But, and here's the catch, they ask you to skip all the detailed audit procedures. Now, what's going through your head? Is that even a professional request? Is it allowed? Or is this, a classic exam trap set by ICAI? Well, it's designed to test if you truly get the different kinds of assurance out there. And this isn't just some made-up scenario. We are going to tackle this exact case study right from your material. We've got Raja and Company, auditors for exotic tours. The management wants a report on their quarterly financials but says, hey, can you just, skip the heavy-duty procedures? By the time we're done here, you'll be able to write the perfect full marks answer to this question.
First things first, we have to lay a strong foundation. Before we can even argue about whether assurance can be reasonable or limited, we need to be crystal clear on what an assurance engagement even is. These 5 elements are the absolute non-negotiables. I want you to think of every single assurance engagement as a structure built on 5 essential pillars. You need the three-party relationship, the right subject matter, suitable criteria to judge it by, enough good evidence, and a final written report. If you're missing even one of these pillars, the whole thing comes crashing down. It's simply not an assurance engagement. So let's look at each one.
Pillar number 1, the three-party relationship. This is super important. First, you have the practitioner. That's you, the professional. And notice the language here. It's practitioner, not just auditor. That's a huge clue that assurance covers way more than just traditional audits. Second, you have the responsible party, which is usually the company's management. And third, you have the intended users, the investors, the banks, the people who will actually use your report to make decisions.
Next up, elements 2 and 3. You need something to check, and you need a yardstick to check it against. The subject matter is the what you're examining. It could be financial statements, internal controls, you name it. The suitable criteria is your yardstick, the benchmark you're using. This could be accounting standards, the Companies Act, or any other relevant law. Without a clear set of criteria, giving assurance is impossible.
All right, element 4, and I want you to lean in for this one, because this is where so many marks are just thrown away in the exam. We're talking about evidence. The words sufficient and appropriate might sound similar, but they are worlds apart. Sufficient is all about quantity. Did you get enough evidence? Just the raw volume. But appropriate, that's about quality. Is the evidence you got actually relevant? Is it reliable? You absolutely need both. Having a mountain of useless evidence is worthless. And finally, the 5th pillar, the written assurance report. This is the end product, the thing you deliver. It's not a verbal confirmation or a quick email. It's a formal, written document where you clearly state your conclusion and communicate that level of assurance you found to the users.
Okay, now that we have those 5 pillars firmly in place, we can finally get to the heart of the Raja & Co. problem. That little request to skip detailed procedures directly relates to the different levels of assurance you can give. This is where we break down the critical difference between reasonable assurance and limited assurance. Okay, this table right here, this is basically exam gold. You absolutely have to know this inside and out. On one side, you've got reasonable assurance. That's your full-blown audit, right? We're talking a high level of assurance, which means we need to do extensive, deep dive procedures. The end result? A positive opinion, something solid like the financial statements give a true and fair view. Now, on the other side, you have limited assurance. This is a review. It's a lower level of assurance. The procedures are much less detailed, and the conclusion is framed negatively. You'll say something like, "Nothing has come to our attention. See the difference?" And this review? That's exactly what Raja & Co. are being asked to do.
So far, everything we've talked about, audits, reviews, it's all been about historical information, stuff that's already happened. But what if a client wants you to give assurance on their financial forecasts? Can you actually give assurance on the future? Let's dig into that. The distinction here is pretty straightforward, but absolutely fundamental. Historical info is about the past. It's happened, it's verifiable. Prospective financial information, on the other hand, is all about the future. It's built on a series of assumptions about events that haven't occurred yet, like projections and forecasts.
And this quote is something you should probably memorize, because ICAI loves to test this concept. You can never, ever, ever give an opinion on whether the projected results will actually happen. You're a practitioner, not a fortune teller. Your role is strictly limited when it comes to the future. So what can you do? Well, you can provide a moderate level of assurance. Your job isn't to say if the forecast is correct. Your job is to check if the assumptions management used to build that forecast are reasonable. Your final report will reflect that. You'll say something like, "Based on our examination, nothing has come to our attention to suggest that management's assumptions are unreasonable." It's a very specific, carefully worded conclusion.
Now, as you can imagine, all these different types of engagements, audits, reviews, examinations of forecasts, they aren't just made up on the fly. There's a strict rule book that governs every single one. So let's open up that rule book and look at the engagement standards. You need to be familiar with these 4 main categories. You've got SAs for standards on auditing, SREs for standards on review engagements, SIEs for standards on assurance engagements, and finally, SRSs for standards on related services. Knowing which acronym applies to which type of work is key.
Let's make this simple. When you're dealing with historical information, it breaks down like this. If you're doing a full audit to give high reasonable assurance, you follow the SAs. But if you're doing a review to give limited assurance, like in our Raja & Co. case, you have to follow the SREs. It's that clear cut. Now for the other stuff. If you're providing assurance on something that isn't historical data, like those financial projections we talked about, you'll use the SAS. But listen up, here is a massive exam trap. SRSs, Standards on Related Services. These apply to jobs like helping a client compile their financial statements. A service under SRS provides zero assurance. None. ICAI loves to ask questions to see if you'll confuse a compilation with a review. Don't fall for it. SRS means no assurance. And watching over all of these standards is SQC1, the Standard on Quality Control. Just think of it like a giant umbrella. It covers every single service under all those standards. SAs, RAEs, all of them. It basically mandates that every CA firm must have a robust quality control system to make sure all the work is done properly and the reports issued are the right ones. Okay, so we got the rules and the technical side down. But being a great practitioner isn't just about knowing the standards. The study material also points out the essential personal qualities you need to bring to the job. It's about who you are as a professional. And what are those qualities? Well, integrity and independence are the absolute foundation. Without them, you have nothing. But it also takes tact, caution, and firmness. You need good judgment, patience, and reliability. And of course, on top of all that, you need a deep, exhaustive knowledge of accounting. It's the combination of character and competence that makes a great auditor. Okay, we've gone through everything. The 5 elements, the different levels of assurance, the specific standards for each. We have all the pieces of the puzzle. So let's bring it all home and answer that question we started with. Can Raja & Co. actually do what Exotic Tours asked them to do?
And the definitive answer is yes, they can. But here's how you frame it perfectly for the exam. You state that Raja & Co. can accept the engagement, but it will not be an audit. It will be a limited assurance engagement, specifically a review. Therefore, they must follow the standards on review engagements SREs, not the standards on auditing SAs. And here's the kicker you must include. Even though a review involves fewer procedures than an audit, they are still required to obtain sufficient appropriate evidence to support their limited conclusion. Skipping detailed procedures doesn't mean skipping the need for evidence. And just like that, you've taken a tricky ICAI problem and turned it into an easy full marks answer.